Well, hello everyone. Thank you for joining us today, and I appreciate you all carving out the time. I'm Casey. I'm a director at Forge, and we'll be moderating the discussion today. We'll be recording this, so we'll share it in a follow-up. Don't feel like you have to take new notes too intently. But we have an incredible speaker. I'll briefly set the stage first, before we dive in. We're all here because we're interested in embedded fintech, for some reason or another, and we know embedded payments has been around for a while, but in the last few years, embedding financial services, whether it be payroll or accounting or lending, tax, marketing, what have you, directly into software platforms is becoming more and more prevalent. And so most of this conversation is centered around which embedded fintech products to launch, when to launch them, and whether your platform has the data, the adoption, the positioning to do this right. And we'll go more into what right looks like. But two main reasons we're doing this now. I'd say one, this is all still pretty new, and it's different for every business, and it's happening now. We have not scratched the surface on embedded fintech. 80% of the $185 billion embedded finance market is still untapped, and most of that's been tapped into is through payments. And then the second being embedding payments and the data that you get your hands on from doing that is what unlocks these other embedded opportunities. So it's very relevant, for the crew today, given the audience is mostly payments-enabled platforms here. And quick second on me, I've been working in private equity, focused on vertical software and payments since I started my career, and I've spoken with thousands of businesses, including embedded fintech vendors across all the categories that will come up today. I always make a point to discuss the embedded topic with companies, have a good pulse on things like adoption rates and implementation times and potential ROI and other things you may be curious about. And in a little context on Forge, think of Forge as the private equity vehicle built inside of the Bessemer rails that leverages the resources and the network and the learnings that comes from BVP in addition to our own operating resources. And we have a ton of experience in vertical software. We have backed a lot of early vertical software winners that are, doing the embedded stuff actively. If you think about Toast, who was incubated in our office, MindBody, Service Titan, Procore, GiveButter, and probably the best example, Shopify, who started with Shopify Payments, then launched Shopify Capital, their lending product, then Shopify Balance, their banking product, and most recently launched a card issuing offering, Shopify Card. And so now if you look at that business, 75% of their revenue comes from financial services. And this is part of why we think at Forge we can be helpful to companies like yours, is because we've seen these stories to scale and want to be a sounding board as you think through your strategy here. Since, as we know, it's a lot more than just an integration. And I think what we do complements what Joshua and the Rainforest folks do on the front end really nicely. There really is no better person to talk about this topic than Joshua Silver, who's our speaker for the day. He's the founder and CEO of Rainforest. Joshua has spent his entire career in embedded payments and has advised many software platforms on their payment strategies. So, Joshua, can you walk us through your journey and just a bit of the context of what led you here today?
Absolutely. Well, first of all, Casey, thanks so much for having me on the webinar today. I am the founder and CEO here at Rainforest, and I've been in the embedded payment space for over 20 years now, which is really since the inception of embedded payments. I started my career as the co-founder of PatientCo, which was a healthcare payments company. We were one of the first healthcare companies to drive most of the revenue through payments and other embedded fintech. Spent about 12 or 13 years with that venture until it was acquired by a private equity firm that renamed it Waystar. And then subsequent to that, ran a consulting firm where I advised more than 50 software platforms at all different stages on how to build their payment strategy, how to negotiate with vendors, and really how to take things to the next level. And that was when I created the idea for Rainforest. Was I saw on the one hand, there were so many companies interested in driving embedded fintech and payments. And on the other hand, I saw that the industry wasn't ready to provide those services and infrastructure in a way that vertical SaaS companies was ready to consume it. And so because of that, we started one of the first purpose-built embedded payments platforms in the market called Rainforest. And that was about 4.5 years ago that we got Rainforest started. And today we serve over 100 software platforms, both on payments as well as starting to enter into other flavors of embedded fintech.
Nice. Thank you for that, Joshua. And for those who aren't familiar with Rainforest, can you give us a quick overview on what makes you guys different from other embedded payment solutions out there?
Absolutely. So Rainforest is 100% focused on software platforms. We don't do direct merchants. We don't do anything else besides really focus on helping software platforms embed payments. And we've created a really unique model called Payfac as a Service, where we handle all of the complex payments aspects, whether it's merchant onboarding, underwriting, taking the risk, managing fraud, managing the relationships with banks and the card networks, et cetera. All the software platform has to do is integrate with Rainforest, and then they've created a very valuable revenue stream. And as we'll talk more about on the webinar as we progress, that creates a huge, huge opportunity not only to increase revenue and margin, also stickiness for customers, as well as improving the enterprise value.
Totally. And we alluded to this earlier, but you hear, it brought up a lot that nailing payments needs to come first, and doing that right is really essential before moving on to any of these other topics, banking, lending, insurance. What does done right look like in practice, and how do platforms, know when they've crossed that threshold and are ready to think through these other embedded fintech capabilities?
Well, Casey, as we've talked about in the past, oftentimes software platforms start with payments. Money movement typically is the first piece of the puzzle, and you really need to nail that before you're ready to tackle other forms of embedded payment or other forms of embedded finance
Mhm.
and fintech. You kind of know once you've tapped that out, once you have really good adoption. So once the overwhelming majority, if not all, of your customers are in fact merchants, meaning they're processing with you, that's a really good sign that you've moved from ramping to ramped in terms of your adoption of payments. And that's actually something that our customer success team at Rainforest tracks for each and every one of our customers is, are they implementing? Are they ramping? Are they ramped? We want to get, of course, as many clients to ramped as possible. Beyond that, you really need to ask, are customers asking for these? A lot of times it's investor driven, investors saying, hey, can you add lending? Can you add insurance? Can you add payroll? Can you add accounting? And when you go and talk to the software platform executive team, how many of your customers are asking you about these things? If the answer is zero or very few, that's typically not a great sign that it's a good time to move. So I think you really want to make sure that you've tackled payments first because each one of these requires a lot of focus. What you don't want to do is spread yourself so thin. I've seen a lot of software platforms that end up looking like a Chinese menu where you have 17 different options. And really, what you want is that one or two or three dishes that are cooked really, really well, like a fine dining restaurant, right? That's the kind of the goal instead of spreading yourself too thin. So that's a couple things high level is making sure you have the adoption. Is there the demand there? And can you really dedicate the time to focus on it so that you're not spreading yourself too thin?
Yeah, and diving deeper on that one point of, the data that's in the payments that you're unlocking. Like what is in that data that allows you to leverage that to say, take lending or issuing that allows you to expand from one to the other?
So I think a really important thing to consider is what problem are you solving? And usually it's SMBs. Most vertical SaaS companies are serving either SMBs or middle market companies. There are a few that are serving truly enterprise, Fortune 1000 companies, but for the most part, vertical SaaS is focused a bit more down market. And so understanding the true pain points of your end customers. For example, there's a lot of businesses where cash flow is extremely tight, and managing that even within a couple of days makes a big difference. And so for something like that, lending is a really good area to kind of go into and expand into. For others, they may have more of a reconciliation challenge, and therefore things like the accounting can come into play. So I think it's about taking the data points from the customers, really truly understanding what does your end customer what are your end customer problems and how can you map those to good solutions? That's Those are the primary data points you need. It's not necessarily a mathematical formula or,
Yeah.
once you have X percentage of adoption, you have this unlock. It's using some of those qualitative as well as quantitative signals from the customers. And again, what you don't want to do is have this executive driven or investor driven. You really need to match that supply and demand. And unfortunately, I don't see that happen enough. And that's where you end up with the failures. And I know we'll talk more about that later.
Totally. No, and it seems like the data that comes from these payments really helps with underwriting, and you have visibility into these companies in a way that a bank or other folks couldn't necessarily have. So it makes a lot of sense. We kind of jumped right in here just to back up a step. Can you give us a sense for why platforms should be thinking about fintech in the first place and just dive deeper into the revenue opportunity?
Yeah, absolutely. Let me share a couple of slides here that I think are pretty telling about this. So just two or three quick slides here. The first is from Grandview Research, and they did a market sizing exercise. And they did this a couple years ago, but as you can see, over the course of 2020 to 2030, the embedded finance market has just absolutely exploding. And I think the most interesting thing about this graph is not only nearly 33% compounded annual growth rate, CAGR, between 2024 and 2030, which is amongst the fastest of any markets, probably outside of AI, but any more traditional market. The other thing that's pretty interesting here is you start to see more colors on the graph as you move further right. Early on, in the early years, embedded payments really is taking the lion's share of the market size. As you move into the late 2020s and 2030, you start to see these others like embedded investment, insurance, banking, lending, really starting to take more front and center stage. And so that to me indicates that the market is really starting to mature quite a bit. Already, though, a huge market, even back in 2022, is already a $66 billion market. The other thing to note is what does it do for you as a founder or you as an executive of a company trying to build? Couple studies from investment banks as well as from VCs. So on the left-hand side, Andreessen published a study not too long ago. When you add embedded finance and really get that full adoption, you increase ARPU by 5x. That, of course, is annual revenue per user. So you're really able to maximize share of wallet because these dollars are getting spent elsewhere. So if you can start to capture the dollars that are being spent on lending and banking and insurance and drive those through the platform, you get economies of scale. And of course, we'll talk more about the revenue, but you can start to peel those off. On the right-hand side, investment banker William Blair published this based on their research and long history of selling software platforms, uh, roughly a 23% premium on the multiple that you get based on your revenue when you add the embedded finance. And so that's something I like to remind founders all the time is it's not even just if you're adding $1 million of revenue today, if you could actually increase your exit value by two or three X in this case, 23% premium, that's another couple $1 million you're putting in your pocket and your investors' pocket, your stakeholders' pockets. And so really significant there. And that holds true, of course, for both your revenue multiple and EBITDA multiples.
Well said. And similar statistic that I read about that I think applies nicely here is if you take the average SMB spending $1,000 a month on software, only 200 of that or so is going to be from their CRM or their ERP or other workflow tools. 80% of that is financial services. And so that seems to be really where there's an opportunity to increase ACVs and just improve retention because you're embedding yourself in more, having more hooks into the customers that you're working with. It's super exciting. And the landscape for vertical SaaS platforms has expanded a lot in the past couple of years, into lending, into card issuing, insurance, payroll, benefits. I feel like I hear of a new category every week or so. But what are all those categories today? And where are you seeing the most interest right now? And why do you think?
Yeah, we don't have enough time, Casey, on this webinar to go through all of them. We could spend days talking about this. It's a subject close to my heart, but Just these six tend to be the biggest ones talked about today, and especially when we're talking about limiting it to just kind of embedded fintech, because we also have now a lot of embedded marketing. We have embedded group purchasing. We have embedded, it's really extended. But if you really kind of look at the core pillars, certainly payments is the backbone of everything, that money movement. When you build on that, lending tends to be the next area that people look at. And again, when you have SMBs that are cash constrained, cash flow is so important. And when you're able to give them working capital, or on the flip side, you're able to give consumers some type of credit, whether it's BNPL, PayPal credit, whatever the case is, these flexible payment methods, they're going to spend more. And so that both helps cash flow and increases overall revenue. So that tends to be the next. Beyond that, you kind of have a divergence. It really depends on your vertical of where it makes the most sense. Insurance can certainly be a valuable one. It tends to be a really good add-on for verticals because you can get insurance products that aren't just maybe general liability insurance, but could be pet insurance if you're doing pet adoption,
Yep.
or it could be insurance, liability insurance for gyms if you're software for gyms or what have you. So they're very bespoke products. And what I found is the insurance companies will actually pay very heavily for those leads. And that's typically how embedded insurance works. Unless you build your own program, which, unless you have massive scale, doesn't make sense, you typically are getting a referral fee or a piece of every policy that's created. And so it tends to be an easy checkbox. You also now can insure experiences. So think about when you check out at an airline. There's always that box. Do you want to insure your trip? Yes or no? That's the quintessential example of insurance that's being offered in that case to the consumer, not even the business. Touching on the last couple quickly, card issuance. That's when you are issuing a card. It's typically branded, where you're giving that either to the merchant or end customers. And the key question to ask on that is, what share of wallet can you run through these cards? If you find that you actually can have a lot of money coming in for every $100 that's coming into the business, for example, $80 is then being spent on a credit card today. Maybe it's from an American Express card or Ramp or something else like that. Can the vertical experience do much better? Typically, it can. Payroll, pretty self-explanatory. Pretty much every business has contractors or employees. If you're able to put payroll in, there's not necessarily as much of a revenue opportunity there, but there is from a stickiness perspective. If you're controlling payroll, imagine how hard it is to ever unplug that software. Extremely difficult. Banking, if you have a lot of cash that's coming in and out of these businesses, and you can tie that, by the way, to card issuance, those two kind of go coupled hand in hand together, can make a lot of sense. And then finally, we're starting to see more and more interest in embedded accounting. And when you think about most SMBs, they hate doing bookkeeping, they hate doing accounting. If this vertical system of record already has, call it 80 or 90% of the data for the accounting platform, can you get that last 10 or 20%, that last mile, to have that fully featured accounting platform? So I know that was kind of a speed run through, but hopefully that gives everybody a little bit of a flavor of what some of these pillars are.
Thank you for explaining those. And it's pretty clear not all categories are made for everyone. You mentioned it's common for folks to go from payments to lending, but I think one of the takeaways we had talked about before is that not there's not one silver bullet for this stuff. And if you're selling to coffee shops, lending might be the most highly sought after product since your customers probably don't have more than a few months of operating cash versus if you're a youth sports club, we've anecdotally have seen insurance be a good place to start.
Absolutely.
Yeah, higher adoption rates there, and payroll and construction seems to work. There's a company in our portfolio, Miter, who's doing some interesting stuff there.
Yep.
So it's case by case, but it seems like these all have relevance, in today. And when you think about some of the trade-offs or considerations when deciding what fintech capabilities to launch or embed first, how do you think through that?
Yeah. So, kind of what I look at is this three circle Venn diagram. You have to look at the ecosystem, the adoption, and the data. And this kind of is a framework that we've developed that helps companies decide where to go next. From an ecosystem perspective, it's looking at, in this particular vertical, where is money coming in and out of? Is it coming from consumers? Is it coming from businesses? Where are they spending it? Are they spending it on mostly payroll? in which case payroll could be a great example? Is it a asset heavy business? Is it a lot of supplies? We've seen, for example, in the restaurant space, doing group purchasing and procurement is a really big embedded payments play in the restaurant business because so much of the cost of a restaurant is the cost of the food, of course, in payroll as well. The second bubble is adoption, thinking through how are you going to get people over to use this product. Is it, for example, with youth sports, insurance is pretty ephemeral, right? You have a youth sports league, and pretty much every season, a couple times a year, the whole thing is resetting, and so you may be able to displace that. Whereas other types of businesses may only have replacement cycles that are every 2 or 3 or 4 or 5 years, or could be very difficult to replace. And so you need to look at, are you actually going to be able to get adoption? And then the third bubble is data. What data do you have that uniquely positions yourself, your business, to be able, as a software company, to be able to power this offering in a unique way? If you're just, for example, offering a credit card and trying to do better than an American Express small business credit card, you're probably not going to get very much adoption. However, if you have data to do receipt matching, if you have data to look at approving or declining transactions real time, if you have data that can then feed the embedded GLs for accounting, if you have data that can then be rolled up into reports to help grow the business. All of these things are the right ingredients. So, do you have the right fundamental flows on the ecosystem? Do you have the right to win to get that adoption? And then, do you have a unique data play? Ideally, you want to have at least two of these, two of the three that are giving you positive signals. It's a slam dunk when you can get all three.
Yeah, and we've talked a lot about why, embedding financial capabilities in the, software platforms makes a lot of sense. But I've seen examples of folks doing this without going through embedded fintech vendors and building these capabilities in-house. And I'm curious if you have a perspective on, if you've seen some of these early folks doing this in-house versus partnering with EFVs or embedded fintech vendors. Maybe any thoughts on sort of the trade-off of those two and what you think is best?
Yeah, I think, Casey, it all comes down to scale, right?
Mhm.
Just like anything, and for what it's worth, as we've seen the proliferation of these embedded fintech vendors, the scale you need to justify doing it yourself has increased. For example, in the payments ecosystem, 5, 10 years ago, I used to tell people, hey, if you have $500 million of volume with line of sight to a billion or more per year, you could look at going and doing the PayFac registration yourself, which is going to the card networks and banks and kind of building everything from scratch at 500 million to a billion. Today, that math has changed. It's much closer to 5 to 10 billion before you should even consider it. And even at those scales, we see a lot of clients and prospects that are processing north of $10 billion that are still saying, why should we when you've got great players like Rainforest and others that have built everything we need and can do it at even greater scale than us? The little bit of extra unit economics we can eke out just aren't worth the opportunity cost. So I think it all comes down to scale. And obviously, in every flavor of this, the scale is different. Insurance, to launch your own insurance product, even if you have someone underwriting it and backstopping it behind the scenes, still is a lot of administrative burden. And so you really have to believe that over the course of, 2, 3, 4 years, the economic upside is so much radically better than doing it, letting someone else do it. And so I'd say the overall default these days should be bring in a great vendor to do it. They probably can do it better than you. Once you've reached kind of billion-dollar scale or the equivalent in whatever flavor you're talking about, you could consider doing it yourself. Or the other thing is you could enter into some cost sharing, risk sharing, other levers to drive a little bit more of the economic benefit your way without having to go do the build yourself. But in general, Casey, not
Yeah.
usually a good idea to build these yourselves. It's way
Yeah.
more work than you think.
Thank you, Joshua. And in that same vein, I've seen some of the incumbents, take Gusto in the payroll space, build out their own embedded offerings. Do you have a perspective on when you're evaluating, maybe Gusto's embedded offering versus one of these embedded payroll businesses that have seen some, Check, Salsa, et cetera? How
Mhm.
do you think about that if you have a perspective?
Yeah, and I don't want to pick on any one in particular, so I'll
Mhm.
kind of keep it more
Yeah.
generic versus Gusto per se. I think in general, working with a vendor or partner that was purpose built to be embedded is usually the right move. Where while it is true that someone like Gusto has deep experience across all the states with, at a very high scale at doing these types of things, the core DNA of a company that's selling direct to SMBs is very different than the DNA of a company that's a software platform, right? It's different sales, it's different support models, it's different contract models, it's different pricing models. And what I found is there's almost no company that has been able to kind of cross that chasm into it. And I'll take an example in payments just to kind of pick on ourselves and Stripe. Stripe has long sold directly to SMBs. That was their bread and butter. That is how they've grown over the last 13 years, is selling direct to merchants. And a number of years ago, they made an acquisition that has since become Stripe Connect. And what we see is Stripe Connect doesn't get the full attention that it deserves and needs, given that you have these vertical SaaS companies with very complex, robust needs. And it's no surprise because a huge part of Stripe's business is the direct business. It's hard to both be an embedded business and a direct business. Whereas with someone like Rainforest, we're purpose built. And so every aspect of the entire experience, from the tech to the service to the pricing model to the contract, is all bespoke for this model. And so that DNA shift is really hard, I think, for companies to make. So I just haven't, in general, seen many companies that have successfully made the shift to doing embedded and doing it well. They have offerings and they work, but generally not as well as the embedded fintech vendors. I think, Casey, also we'll see in the coming years as the purpose-built embedded vendors gain more maturity. I think then it'll be a no-brainer. And I think, either one of two things will happen. They will either beat the incumbents kind of time and time again, or the incumbents may actually just roll them up. I think we're due to see someone like a Gusto buying an embedded payroll or things like that. It wouldn't surprise me at all.
It's super interesting. And switching gears here a bit, just trying to bring one of these examples to life. If a platform came to you today and said, we want to add lending features, what are the questions
Yeah.
you're asking them to determine if they have the right to win, which is something we've talked a lot about.
Yeah. Happy to share. We've developed this framework, this question framework. These 5 questions, excuse me, are really good to ask. So, and some of this is a repeat, but it's just a concise version that you can almost keep as a cheat sheet. Number one, does it solve a real problem? Again, is this an initiative from the board that says, "Hey, we've heard you can make money on embedded fintech, go do 16 flavors," or is this solving a real customer pain point? If it is, great, move forward. Number two, do you have the right to win? And for those of you who may not know, the right to win means that you are at the point where someone is making a decision. You also typically have the trust. A great example is in payments. When you have the right to win, it means you control the checkout screen. If you don't control the checkout screen, it is extremely, extremely difficult to win in payments. With embedded insurance, if you are selling insurance that's tied to a purchase, for example, a purchase protection plan. Imagine like at Best Buy, you're checking out, you're buying your stereo or your TV, and they offer you an upsell on the insurance product or a travel insurance. If you're not controlling that checkout experience and you're not controlling, for example, the card number or have some way to send that and share that with others, very hard to win that, because then you're having to come back subsequently and say, oh, do you want to insure that purchase you already made rather than it being an upsell? When you make it into two decisions, it's very unlikely to win. Three, do you have the right data? You need to have that transactional operational data required to differentiate. If not, you're just a very generic offering. You're not going to beat American Express or Ramp at a general purpose small business credit card. They just have so much more scale than anyone on this call does, and they just have so much more data. And certainly, American Express has decades and decades of data. You're not going to win. But if you have the right data in your specific vertical, and you have some unique way you're using it, you absolutely can win. And that's where we see a lot of the success. Number four, how much implementation lift is required? It's not just the integration. That's probably the biggest misnomer. They ask you say, hey, I want to add these products. You go out down the hall and you ask your engineering director, hey, how long is it going to take to add embedded insurance? And they look at the API documents and they say, it'll take like, 10 days. A couple developers, 10 days, it'll be easy. Um, that doesn't talk about any compliance burden, rollout, supporting resources, any reconciliation that you need to do on the back end, any data, if there's an accounting impact. You need to look at that whole ecosystem before you can really ascertain what the level of effort is. And finally, how big is the opportunity? Sometimes it's amazing how quickly you can answer the question by just doing some basic math. You say, in an ideal world, if we got the most adoption possible that we could possibly imagine, times some take rate, times some percentage of the payment or percentage of the insurance plan or whatever it is that we're going to get, what's that number? Is that number best case scenario meaningful in the scope of your business? And I've done this with some companies. They maybe it's a $20 million ARR business. You do all the math, and it's like $50,000 you're going to get best case. Not super interesting. On the other hand, we've done this in a $20 million company, and we find, hey, we actually think you could double the size of the company. There's $20 million here, best case. Now, would we get it all? Probably not, but that's a really good place to start versus having a very small percentage of your revenue. People often skip that step, and it's surprising how easy it is to do the math if you have a good partner to work with who can give you some of those high level numbers.
It's all very helpful. And to your point on number four, this isn't just an integration. There's an operational component to it that spans across customer success and sales and marketing and finance. When you think about pricing and packaging decisions and lead gen and marketing, and how do I incentivize customer success or structure that org or think through best practices in terms of forecasting adoption. It's all stuff that we think at Ford we could be very helpful with, and it complements what Joshua and the Rainforest do on the front end really well, we think. And on this point on number three, you've talked about, or we've talked about having the right data to power these fintech products and offerings. Can you give a concrete example of what good data looks like, and then what disqualifies a platform for pursuing a certain product? Maybe just fleshing out that third point more.
Yeah, I can give two quick examples. Um, One would be, let's take payroll. If you're the system of record for scheduling the employees of your clients, that's a really good sign you have the data because that goes right into payroll. If you don't, how are you going to do payroll, especially if it's more of an hourly based or session based type contractor? You have to figure out how to get that data. And oftentimes it seems obvious, but people miss it. Another good example would be on the card issuance. Is some of the spend already going through your platform? Do you have the data into the spending trends? Are the clients coming to your software platform to look at buying things, whether it's procurement or whether it's budgeting or something or inventory even that would kind of tie into that? Because if they do, it's a natural fit where you already have that tie-in. And you have a leg up on the competition because you can better control spending on it. For example, instead of having to go into Ramp and manually set a spending limit, if your platform has data, you can automatically create virtual cards that have the right and appropriate limits given the historical nature of the business. That's a really compelling value proposition, especially to a small business owner who doesn't have the time to go in and manage individual credit limits for things, but also wants to have control.
And maybe a specific example in terms of just embedded fintech stories you've seen go right or wrong. Maybe we starting on one that you've seen gone wrong, because I think that sometimes can be even more helpful, and what the root cause of it was, or any learnings or advice you have from the other folks on the webinar here.
Yeah, I can give. There's so many examples of when it went wrong. Unfortunately, the overwhelming vast majority of the time when it doesn't work out, it's an adoption problem. You do all this work, you get engineering to do the work, you get sales to try to sell it, you get support all geared up, you get success, you get legal. You do all this work, you get to the end, and nobody clicks the button. They just don't consume the product. And so that's the vast majority. And I can think of there's a retail platform that I did some work with that thought they had a really compelling value prop on insurance to basically insure the product or the experience when the purchase was happening. It turned out that the thing they missed was consumers weren't really worried about that particular product breaking. It wasn't like an electronics product, it was something else. And so there was kind of this mismatch of expectations, and nobody did the work to see, do people care? And it turned out they didn't care. Another example is in the payroll space. This was a platform that was kind of in a field services space, not to get too specific, and they thought they could do payroll for um, all the contractors and the employees. And it turned out that a lot of their clients actually used a different platform for scheduling the workers. So this platform got the interest from consumers and, fill out slots for consumers that had consumer scheduling, but they didn't have the data for the back-end employees. There was a different platform for that. And they hadn't realized that and identified it when they said, hey, payroll makes a lot of sense because they said, we do scheduling. They did the consumer scheduling, not the employee scheduling. So those are kind of two examples of, again, kind of smack in the face moments at the end. And you're like, yeah, it's obvious why it didn't work. In hindsight, should have asked those questions. Here we are.
Yeah. And we talked up front about Shopify and some of these, success stories, but are there businesses or a business that you followed that's really gone about this the right way that names or no names that you look up to in terms of their approach to this stuff?
Yeah, absolutely. We see a good example, I think, would be in the pet adoption space. We have a platform there that's done very, very well with pet insurance. That is something that people worry about when you go and adopt a dog from an animal shelter, for example. One of the first things you're worried about, you don't know the history of the dog or the pet. You need to get insurance, and so you're also catching consumers in a good mood. They're just adopting their pet, bringing it home to their family, and so that's the perfect opportunity to add that insurance product. Plus, they also have the data because they are the system of record for those animal shelters, and so they know the breed, they know the weight, they know all the information that you need to be able to generate that insurance quote in real time. That's a perfect example of those three circles. They have the data, they have the ecosystem, they have the mind share, they got the adoption. And that was just an absolute home run.
That's a good one. And this is in the Forge portfolio. It's earlier in the journey, but GiveButter is a nonprofit software platform that we backed a few years ago. That was always had an embedded payments offering, but they launched Wallet
Mhm.
recently. So now customers can earn 2.5% yield compared to I think it's 0.07% that you'd get from a traditional bank.
Yeah,
And that kind of just goes and speaks towards what this data allows you to do and how you can underwrite better. And now they're getting into issuing and looking at automated payouts. But there's a lot of really interesting examples of companies that are doing this and it's working well. And they're one where they've realized that they don't need to charge, for the CRM or for the software that they're selling. They're almost entirely monetizing on these financial services. It's a pretty much a fully transactional business today. So I think it's another kind of interesting point to lead us to. Have you seen a lot of those stories of just businesses? Have you seen more of that where businesses are getting more comfortable giving away software for free and monetizing fully on the financial services?
we have. And it's something that in many cases we encourage because it creates aligned incentives. Also, you don't get into the pricing pressure game. For example, with payments, if you're charging for software and payments separately, everyone's going to compare your prices to the competitors and to Stripe and so on and so forth. And so there's a ceiling in what you can charge. When you start looking at selling outcomes-based pricing, that's really when you can start to charge a lot more of a premium because nobody can figure out what the bundle is really worth. And it's something I saw in the healthcare space, 15 years ago, we saw a lot of billing companies. They used to charge, X cents a statement and Y cents per minute for the phone agent and Z dollars for a long laundry list of services. They finally said, look, I'm just going to charge you 7% of every dollar I collect, however I do it. And I have now an incentive to optimize my cost structure. I have an incentive, I've aligned incentive to drive as much collections as possible. And the industry really rallied around that. And these are, many, many billions of dollars that are flowing through the healthcare system these days based on this. They call it a contingency model. I like to call it a success-based alignment fee, but it's all the same thing.
Yeah. And switching gears to thinking about selecting, a payments provider, or maybe for folks who are considering switching, what's the difference when you think of best of breed versus best of suite? Why is best of breed the more logical decision? I know we've talked about this in the past, but I'm Curious to hear you talk through that.
Yeah, let me share. We've seen the market kind of bifurcate into two different classes here. So best of suite is where one vendor says they can do it all. And I think Stripe's a good example of this. If you go to Stripe's homepage, you can see there's a long, long laundry list of products they support. And Stripe would make the argument, come to us, you can get Stripe Treasury, you can get Stripe Capital for lending, you can get, of course, payments and the business formation, and the list goes on. Others, like Rainforest, have said no, a best of breed approach actually works better because Rainforest is a best in class payments provider, but we're not necessarily best in class for lending. We want to give you choice to bring in the lender that you want to based on your vertical. And I think the most basic example that I think even if Stripe was on this call, they would agree with Stripe Capital, it's not going to work equally well for healthcare, where you need consumer financing to pay your healthcare bill, as it would for trucking, where you need factoring to help with the trucking carriers, and working capital for a small business, right? Those are all very different financial products. It's almost impossible for one lender to be really good at all of them. And so what we've done at Rainforest and what I would encourage others to do is look at a best of breed solution where you pick for each category, whether it's issuing or lending or capital or payroll, pick the best one there. Over time and over the years, it's likely that some of these companies will get better or worse, and you may need to shift them out. You don't want to have all of your eggs in one basket. It creates a lot of leverage for that provider, and it makes it very, very hard for a software company to be able to launch these products. And what you don't want is to have lock-in. The other interesting piece that's kind of a more unique innovation is with the ability to create what we call a merchant vault. And what that means is even though Rainforest is not doing the lending, for example, what we can do is we can deduplicate merchant onboarding, meaning Rainforest doing payments and a lender issuing a loan needs basically the same information. The bank account of the business. You need the ownership information, the tax ID, all this. What we can do is we can store that securely on behalf of the merchant and the platform, and then send it to these other providers behind the scenes using what we call the forward API. And so that's how you truly achieve a seamless experience for the merchants, meaning they don't even know it's necessarily a different vendor or a different partner. Seamless for them, but you still get that best of breed opportunity. That I think is the trifecta of this situation where you get kind of you can have your cake and eat it too, right? And that's very different than when you go to just a single ecosystem that's very closed and you don't have that opportunity.
And I think this segues really nicely into the topic of AI, because if you do this right and you become your customer's financial operating system, you're not easy to displace, compared to a CRM alone, which also isn't easy to displace. But once you get your hands on payments and insurance and lending or any combination of those, you just get a lot stickier. How do you think about this in the context of AI and now that, building software is cheaper and easier than ever? What is the role of embedded fintech and vertical software? And do you look at this as a means to reducing, the risk of new entrants, coming in and stealing market share?
I think it's absolutely a moat because the cost of building software is coming way down. The speed is going way up. At some point, it's all basically the same. There's only, you can only have only so many CRMs for roofing that all have market share, right? Just to pick an example. And so I think when you can create a moat with embedded fintech products, that takes time. It takes time to build those relationships, to negotiate, to get the adoption, to figure out what works, to loop in the data, to train your teams. All of those things are defensible moats, especially when you do more than one flavor. And so I think this will become increasingly important. The other thing I might add is, and there's a lot of discussions going on about this in various channels these days, system of action versus system of record. And as we all know, systems of record historically have been kind of the centralized CRM, the database of all the things that are happening, but you needed humans to go and do action on them. Systems of action are increasingly with AI performing the actions themselves. And so I think it's important in your industry to think about as you have AI empowered agents, whether it's truly autonomous or more of a co-pilot, how is it going to change choice? How is it going to change how these services are consumed?
Mhm.
If AI is going through a checkout process, for example, does it know whether it should buy an embedded insurance product? Maybe it has more data even than the company because it goes out and says, what's the failure rate on this product? And if it's over a certain percentage, it can do the calculations instantly and figure out, yes, this is actually good arbitrage buying the insurance or not. Just again, as a very kind of, toy example. But I think it's really interesting, especially in the B2B context, to think about, will AI think about allocations of treasury? Back to your example, Casey, on Give Butter, the yield management.
Yeah.
Will AI do that? And I'm seeing in many cases, yes, it will, and quite well, in fact. Uh, Exciting times.
Yeah, to say the least. And anecdotally, just in conversations, I feel like I hear a lot. The founders acknowledge that certain embedded fintech products are interesting and make sense for them to explore and probably things that customers would adopt, but they're lower on the priority list and it's just not something they're
Mm.
doing. And maybe it's, other AI initiatives, maybe it's scaling go-to-market teams or international expansion, or there's a lot of different things that you could stay busy with as a founder. But as a three-time entrepreneur and founder yourself, how would you think about how to prioritize these initiatives as a founder?
I oftentimes hear people say once they've done it and it's producing a lot of sticky, high margin revenue, they say, man, I wish I had done this earlier
Yeah.
because they can see the adoption curve and they say, if I had just started this 2 years earlier, my business would be worth $35 million more today when you kind of do the math. And so very rarely do I hear people say, we started too early. Almost everybody says we started too late. And so I would encourage you, these things do take a little bit of time to simmer in many cases. So you want to start earlier than later. One, two, the other thing to look at is the economics. And AI is kind of the shiny object and I dare say imperative today. In some cases, AI doesn't generate a for sure return. There's this murky, we think there's ROI, there might be at some point we think it'll get there. Sometimes embedded fintech, if you're pretty sure on the adoption metrics, can result in pretty sure revenue. And also, by the way, in almost all cases, it can be recurring, and except if it's like a one-time insurance purchase. But generally, embedded fintech revenue is recurring. And so it's the gift that keeps on giving. You do the work today, you get someone on payments, or you get someone on banking, or you get someone on issuing. As long as they don't churn, you're going to keep going for a long time. With AI, you may see a one-time boost. You may not see the ROI there. It's a little bit less in most cases of a sure thing. As we all kind of figure out how to navigate this evolving AI landscape and ecosystem together. So again, it all comes down to the math. In some cases, it really is a home run and you can make a lot of money on this embedded fintech. In some cases, you can't. And so it's about looking yourself in the mirror, talking to advisors, talking to the partners in the space and figuring out where do we think this is going to land. And if we think it's a sure thing, you may want to put it ahead of some other initiatives, whether it's AI or not, that may not be as sure a thing.
Yeah. That makes eminent sense. And it's something we talk a lot about internally, so it's good to hear your perspective on it. Last one for me, and then we could do some Q&A if folks want to put questions in the chat here. There was also when you were registering the questions there, we've saved down so we can go through some of those if there's time. But outside of vertical software, a lot of what we've talked about has been thinking about SMB facing vertical software businesses. When you think about marketplaces or in the AP, AR automation world, how is this stuff relevant there? And maybe talk a little bit about, any of the work you've done outside of, traditional vertical software businesses.
Yeah, so AP and AR, in the B2B space are really important, and that's where you can start to get into things like card issuance, for example. And
Mhm.
instead of sending a check to a someone who's receiving a payment, can you send a virtual card instead, and then make basically a piece of the interchange or a piece of the money that the merchant's paying to process that you get back as a rebate. That has kind of its own nuance of, again, what's the adoption going to be? You can build it, but what percentage of the tech checks can you convert? I also see in the AR and AP space, the automation itself can be really valuable. So the reconciliation, the posting, the approval processes, the chain of custody of funds, the time when it's being sent. All of those things are almost as important as the rail. And so it's not always the case of, well, we're sending an ACH payment, we're going to make a bunch of money doing it. It's can you replace the process that would be done offline, which costs in many cases somewhere between $7 and $15 to send a paper check. Could you charge $2 or $3 or $4 for it? Because you're adding value on the process, not 10 cents for an ACH.
Yeah, and it's interesting how long this stuff has been around, even pre, software. When you think about embedded partnerships or offerings, think of the airline loyalty and rewards programs where they're making most of their
Absolutely.
money. Or you mentioned check the box
Yep.
travel insurance. I saw an interesting one the other day with Netflix paying Roku. I think it's like $1 a remote to embed their button on all of the
Yep.
Roku remotes. And now they've done it with a bunch of other, device OEMs. But now 80% of Netflix views on traditional TV comes from people clicking that button. So it's like a totally different example outside of technology, but I think it just goes to show meeting the customers where they are is super important. I'm pulling up the chat here. Just let's see if there's a good one to ask you live, Joshua. When you embed financial services into a non-financial platform, how do you think about who really owns the customer relationship and the data there?
It all comes down to the contract. It's really important as a software platform when you're negotiating with a vendor to clarify that. Historically, in the payment space, most payment arrangements were referral relationships. And so you ended up in a situation where you, as a software platform, had all these clients, you referred them to an ISO, which is a sales organization. Um, and they basically owned your clients. And so you gave away the keys to the kingdom. That's very different than with someone like Rainforest, where we actually contractually say our client, the software platform, owns the data, they own the customer, and they have full portability over it. And so that's kind of two complete ends of the spectrum of ownership. But again, it's all negotiable. You have every flavor, and so make sure that you have as much ownership as possible. And you can have ownership, but not have the risk. And that's a great example of where Rainforest has innovated. If we said traditionally, whoever owns the customer also owns the risk, we've decoupled those. And so have some of our good partners in other flavors of fintech as well. But you have to ask the question.
Well said. We'll go rapid fire on a few of these. What
Okay.
additional organizational complexity and financial sophistication of employees is needed to implement these services?
So typically not too much on the financial sophistication side. The main things you need to think about is engineering needs to implement it. So engineering a product, you typically need some type of success function to help with the rollout and answer questions, whether that's support or success. And then traditionally, you also are going to need sales support. For new customers or even enablement of existing customers, those are typically the three pillars, sometimes an operational angle.
Yeah.
What I've seen is more and more of these models, though, that's all being outsourced to the vendor, to someone like a Rainforest. So less and less is the answer as we get more and more maturity around embedded payments and fintech.
It's awesome. And it's a good one for you, almost a layup for you. But when you think about how Rainforest enables platforms to embed additional financial services, maybe just a few seconds on how you guys help with that.
Yep. So a couple different ways. Number one is we're forming that really good foundation for payments that forms the basis for all the others. When you get good adoption with payments, it opens the door to lending and banking and everything else. So that's part one. Part two is with that forward API and that merchant vault, we're able to not only send transactional data out to third parties securely, but we can also send the merchant data. And so we're helping people create seamless experiences for the end merchants but still maintaining that best of breed orientation.
Take two embedded fintech vendors that are doing the exact same thing. How would you think about how to evaluate which is right for your business?
Number one, I would say, is support. Who do you want to be on the other end of the line when you have a problem? When I was consulting and working with dozens and dozens of software platforms, that was the number one decision criteria, I'd say, because at the end of the day, economics generally trend towards the mean. You can figure those out. Contract terms you usually can figure out. The technology, is usually a one-time thing. You want it to be good, but it's only got to be good enough. But service, you have to have good partners because these things are complex. Back to that last question, you're relying on this partner for providing not only ongoing support to you, but also to the end merchants in some cases. And it's a real problem if something doesn't work. Think about how angry your customers would be if payroll didn't work this week. You'd have big problems. Or if money didn't that they processed yesterday didn't end up in their bank account today. That's a really big problem. And the absolute worst thing in the world as a software platform is when you're left to face your customers alone because your partner doesn't have your back. And unfortunately, in this industry, many people do not provide good service. And so that is absolutely by far and away the number one criteria you should use when you're selecting a partner.
Nice. And I think we have time for one more here. When you think about some of the newer categories that maybe we're still learning about that haven't seen as much adoption to date, think maybe surcharging or background checks or some of these other categories. Have you seen success stories here, even as early as it is, and where would you prioritize these? And I imagine a lot of that is case by case depending on the business, but just curious on
Yeah,
your thoughts.
I think we're starting to see a long tail
Yeah.
of embedded opportunities, which is for me is I think super exciting. So I think fast forward if we do this webinar in 24 to 36 months, I bet we will fill out the monopoly board of all the different pieces that are gaining meaningful market share. I went beyond the ones I highlighted. I wouldn't say that there's kind of any one in particular that I would say has gained kind of you know mass market adoption yet. It certainly is early adoption in many cases, but that leads to mainstream later. So I think if you use those frameworks I presented, both the three circle Venn diagram as well as the five or six questions, those two are going to get you 90% of the way there that you would have historically had to pay my consulting company to come and do an engagement for you. We've given you the cheat sheet. It'll get you 80, 90% of the way there and get you
Yeah.
off on a good start.
Yeah. And to your point on the long tail, I think one of the questions I've always had, and the jury's still out, is will we start to see more consolidation amongst these embedded fintech
Mhm.
vendors, which I see pros and cons of. I don't think that that's the answer here necessarily, but this is awesome, Joshua. And it's really great chatting with you about this stuff. You're more qualified than anyone to give this perspective. So I'm glad we got the group together and did this session. I think a big takeaway is that the stuff that we're doing on the embedded fintech front at Forge and helping our companies, implement these initiatives complements what you guys do really nicely on the front end. And so to anyone who's interested in chatting more about this and thinking, formalizing your strategy here, just any questions that come to mind, you know where to find either one of us and Joshua or myself or Forge or Rainforest. And we'd love to be a sounding board to you as you think through this stuff further. So appreciate you all making the time to join today and stay tuned because there's likely going to be we're thinking of doing another panel in the coming months where we invite different embedded fintech vendors and let them kind of each
Mhm.
have 5, 10 minutes to talk about what they do and how they're different and all that stuff. So I think that's a new take on this that would work well. But yeah, appreciate everyone's time.
Thanks, everyone. Thanks, Casey. Thanks, BVP Forge. This has been
Awesome.
great.
Yeah, thank you, Joshua. Bye, everyone.
Bye for now.